Ever wondered what a company actually does with $1 billion in profit? Well, they don't just lock it in a vault. They put it to work. And believe it or not, there's a secret playbook that guides every single move. And today, we're going to break it all down. So, let's put you in the driver's seat. Imagine you're the CEO. You've had an incredible year, and now there's $1 billion in cash sitting on the books. What's the play? Do you build a shiny new factory? Do you pay down some debt? Or do you give it back to your investors? This isn't just some textbook question. It is the most critical decision a leadership team has to make.
And this right here is the playbook we've been talking about. This flowchart is going to be our roadmap for the next few minutes. It lays out the whole hierarchy of how companies decide to spend their money. Now, it might look a little complicated at first glance, but it's actually a super logical guide for creating value.
So let's start right at the top of that hierarchy. The entire framework is built around 3 core missions. And the order matters a lot. It's a clear pecking order for where every single dollar should go first.
So here they are, the big 3. First up, investments. This is all about growing the business. Next, you've got financing, which is basically managing the company's financial health. And finally, if and only if there's cash left over, you get to payouts, giving that money back to the shareholders. And you see that arrow on the right? The highest potential for creating serious value is right there at the top with investments.
The entire system, this whole playbook, is built on one simple golden rule. A company should only invest its cash, whether that's on a new project or buying another company, if the potential return is bigger than what it costs to get that money in the first place. It sounds obvious, but this right here is the engine that drives all value creation.
And here's the formula they use to measure it. ROIC has to be greater than WACC. Now, ROIC is just the return on invested capital, the profit you make. WACC is the weighted average cost of capital. Think of it as the blended interest rate the company pays for all its money, whether it's from loans or from shareholders. As long as that return is higher than the cost, you're making money. You're creating value. Simple as that.
Okay, so let's say a company has funded all its amazing value-creating projects. What's next on the playbook? Well, that brings us to mission number 2, financing. This is all about managing the company's financial structure, and a huge part of that is figuring out exactly how much debt you should have.
Now, you might think debt is a scary word in business, but check this out. It's actually the opposite. This chart shows that the vast majority, we're talking over 70% of the biggest companies out there are clustered in what's called investment grade. That means they are actively and successfully using debt to run and grow their businesses. But it's a real balancing act. This chart perfectly illustrates the idea of a Goldilocks zone for debt. You don't want too little because you might be leaving value on the table, but you definitely don't want too much. Just look at how steeply that line climbs on the right. The penalty for having too much debt is way, way worse than the penalty for having too little.
And here's exactly why that penalty is so brutal. This graph shows the chances of a company defaulting based on its credit rating. As you slide from a super safe AAA rating on the left over to a weaker B rating on the right, the chance that the company won't be able to pay its bills just explodes. It goes through the roof. That's the risk executives are constantly trying to manage.
So why should you, as a potential investor, even care about any of this? It's actually really simple. A lower credit rating means the company has to pay a higher interest on its loans. And every single dollar spent on interest is a dollar that isn't profit and a dollar that isn't going into your pocket as a shareholder.
All right, so the company is invested in all its profitable projects, and they've optimized their debt. But guess what? There's still cash left over. So now we've arrived at the final decision in the playbook. How do we return that money to the owners? The 2 main options here are dividends and share buybacks, and they send completely different messages. Think of a dividend as a direct cash payment. It's steady, it's reliable, and it signals that management is confident. A share buyback, on the other hand, is seen as way more flexible. It's how companies return what they consider leftover cash without committing to that same payment year after year.
Okay, now this is where the rubber really meets the road. Check out the math here. A share buyback or repurchase looks pretty good, right? It boosts the earnings per share from $1.02 to $1.07. But now, look at that last column. Investing that exact same cash back into the business creates so much more value, pushing the value per share up to $17.25. That's a huge difference, and it perfectly shows why investment is always priority number 1.
So this all sounds great in theory, right? But what happens when things go wrong? When a competitor comes out of nowhere or the whole economy just tanks? Let's see how this playbook holds up when it's under pressure.
To do that, we're going to use this table to look at 3 totally different scenarios. First, we've got our normal, stable base case. Then, a competitive disruption, where a new rival starts eating your lunch. And finally, a full-blown economic downturn.
The first thing that gets hit, and it gets hit hard, is cash. Just look at this drop. In the base case, the company has a cash surplus of over $2.7 billion. By the time you get to a downturn, that shrinks all the way down to just $552 million. That is a massive, massive loss of financial flexibility.
So, with less cash to go around, what gets cut first? Well, when times are good, in our base case, the company is planning to spend almost $2.3 billion on share buybacks. That's a huge number.
But now, watch what happens in the downturn. That $2.3 billion plan, it gets slashed to just $102 million. This is that flexibility we talked about. Share buybacks are the first easiest lever a company can pull to save cash when trouble starts brewing. And here's the crucial difference. In that same analysis, what doesn't change? The dividend. It stays locked in at $450 million across all 3 scenarios. Good times, bad times, all of it. And why is that? Because cutting a dividend screams we're in trouble. By keeping it steady, management is sending a powerful signal to the market that says, we are stable, we can weather this storm.
Which leaves us with a final question for you to think about. Now that you know the playbook, the next time you see a headline that a company has cut its dividend, what's your first thought? Is it a desperate sign that they're in trouble? Or could it actually be a really smart strategic move to free up cash for an incredible investment that will create way more value down the road? The answer is all in how you read the playbook. Thanks for joining me.